So let's just start with this webinar. As I said again, I am Jonathan Klein, analyst at PlusOption, and in this webinar we're going to talk a little bit about technical analysts, basically how to analyze the market. Before that, let me just say that right now we all know that this is the earnings season in the United States market. Therefore, usually in the earnings season, as major events in the market as well, a technical analyst doesn't really work, because a lot of things that we don't really expect in the market occur, and they kind of, let's put it like this, messed up everything else for us. But usually, and we're not going to talk about it over here, but it's important to know, usually when we have gaps in the market, it means that the price is open either high or below the time that it previously closed. When we see some sort of hole in the market between the candles, those gaps tend to close, and this is an important thing for us to remember. This webinar as well will take between 25 minutes to 30 minutes. In this webinar, at the beginning, we will talk a little bit about technical analysis and how to analyze the market, and at the end of this webinar, we will go a little bit about the major things that occur in the market in the last few days and what we could look for in the next of the week. As always, if you have any questions, feel free to write them in the chat, and at the end of this session, this webinar, we will have a Q&A, question and answer. So let's just start. As I said in the beginning, what we're going to talk today is about technical analysis, and the major beginning of that is to understand how to read Japanese candlesticks. This is basically the beginning for us. Usually, I will recommend, if you want to take a look at charts, so if you're looking at charts of stocks, you want to look at stocks in the market, I would recommend Yahoo Finance, one of the best sites for looking at stocks charts, and just to get another more information regarding the stocks. Another thing, if we're trying to look at currencies or commodities, investing.com is one of the best sites and easiest site to operate. As well, in investing, and I will show you this thing in the next presentation, we have a lot of things that help us analyze the market. Basically, at that site, we have a lot of free stuff that could help you analyze whether to buy or to sell, or basically to do the first filter of that thing. So let's just start regarding Japanese candlesticks and how everything works over here. First of all, as we can see, we have a green candle and a red candle. For us, the red candle is usually pronounced as bad candle. The green candle tells us that the market of that candle opened over here and closed over there. What does it mean? When we're choosing to see charts with candlesticks, the first thing that we do, we choose a time frame. So if we've chosen a time frame of 1 hour, it means that hour the market opened here below and closed here above. And at that same hour, prices were here below as well and up here as well. The red candle just tells us the opposite. It tells that the market opened here and closed here, and at those time prices were down here and up here as well. Now, there are a lot of things that can tell us, that I can teach you regarding how to analyze just the candlesticks, just to understand what those candlesticks means in the market. But this is for a different session. For us, this is what's important, that we'll understand how they work and what's the difference between line charts and them. Now, the first thing when we analyze the market is looking for, and I think that you probably heard a lot about it from the account manager or just from people around the market, that there are a lot of important support and resistance points in the market. This is kind of the basic, one of the first things that we try to look for. I will recommend after this session, if somebody just write in Google to read a little bit about support, resistance, and pivot points. Pivot points is basically numbers that usually tends to repeat themselves, and with pivot points, the program that you decided to trade with, basically the side that you want to see the charts with, will tell you immediately, okay, look, we have supports over here, we have resistance over here, and it's a lot more easy than to just look forward for them. So basically, what does a support line? Let's start with that. Support line is a place in the market that the buyers and sellers met several times and decided that the price wouldn't get lower than that. And by that, I can tell as a guy that want to trade as an analyst in the market, that's probably next time that the stock or currencies or commodity will reach that price, I will consider open a call position. For example, over here and over here. And as we can see, we saw, okay, the market reached over here. The next time that it reached over here, it got a little safe as well. So if another time we will reach over here, I will probably consider an open a call position over here. And in the future, we expect it to go higher than that. A resistance point is exactly the same, just the opposite. This is what, look at it, is this chart over here. I'm hoping that everybody's seen the chart pretty clear. This is the oil chart from 2 weeks ago. And over here we have several resistance and supports line. Now, how do we paint them? We paint them regular to what happened in the past. So basically we take it from the last days that we have. We all remember this point, 44.6. First of all, this is UK oil, not US oil. They're the difference of $2 usually between them. That's why we see that the low price is 44.6 and not around 46, 47. And as we can see over here, just 2 weeks ago, oil reaches the point of 44.6. Before it, on November 2016, it reaches the same point and then corrects himself more than $10. And we saw the same thing over here. Now, me as a trader, look at this point at November when the market was over there, and just 2 weeks ago when the market again reaches over here, I told myself, look, this looks like some sort of interesting point, a good resistance point for the market. In general, we saw that usually when oil collapses, and this is basically only regarding oil, the conversation around it is very, very important. If people start talking good things regarding oil, we will probably see a good effect regarding it as well. And that's what we saw. In my mind, as we said before, here we're seeing a daily charts, which means that every candle represents a day in the market. So when crude oil reaches that point of 44, I wouldn't open a position for the end of the day, for example, or for the next hours. I will open a position for a week and more than that, because what we're looking at is a one-day candle. And as we said in the previous session, I don't know if you remember, but we said that we will go with a ratio of 1 to 4 when we trade. It's not very important right now, but in the next pages it will be very, very important. So for us, while we're trading, we will take a minimum of 1 to 4. It means that if I'm looking at the candles and the candles told me you should buy, you should open a call position, and I'm looking at the candle of 1 hour, I wouldn't open a call position for the next hour, but I will open a call position for the end of the day, for example. And if it's half a day, I will open a end position in 2 days. This is pretty important for traders because, as we all aware of, timing is everything while we trade. More than that, as you can see over here, we saw, over here we had some sort of a resistance point, and then it turned to support line. So next time we saw again, it just touched it and then did a little correction over here. And yeah, if we open a position for 4 days, 1, 2, 3, 4, probably in some of the position we would have been right, and in some we would have lost as well. Well, this is the market basically. Let me just tell another important thing about resistance and support. When a resistance point breaks, it usually turns to a support. For example, over here, when this point breaks, next time that the market will meet this area of $50, I will expect it to be a support line. And as we saw over here, the first time that it started going down, this was a very, very strong support line for oil. Let's carry on. If there are no any more questions regarding support and resistance, the main difference with support and resistance is that we need to identify them. That's what usually a lot of traders don't really like them. What's important for us, instead of just start going and mess up a lot of charts, let's remember that usually support and resistance are round numbers. So for example, if I'm trading on oil, I will look for numbers like 50, 48, 46, and etc. Or for example, the S&P 500. 2000 was a very, very strong place for it, and after 2100, and etc. Those numbers, those round numbers, we tend, as a buyers or sellers, it's kind of hard to buy or to sell at those prices, and that's what makes them support and resistance. The second thing, which is basically the same, it's trend line. We hear a lot in the market, this is an upward trend, this is a downward trend, and we should trade it. We have an example over here. I don't want to talk a lot about it. Basically, it's the same thing like support and resistance. The reason that I don't want to talk about it is because it's very, very hard to identify it and to trade by it in the market. And on my point of view, the next thing that we're going to talk about are a lot more important, and on the other side, a lot more easy to trade on. Well, the second thing that we will talk about is regarding moving averages. Moving average is basically, first of all, we start with SMA, which is simple moving average in the market. Basically, if we will decide to add a SMA in the market, for example, in a site like Investing or Yahoo Finance or etc., the first thing that it will ask us is which the time frame that we want to pick. Usually, I will pick a time frame between 12 to 20. My favorite is 15. What that number means, it means that the line that we see regarding the last candle will be the average of the last 15 candles. For example, that's how we'll understand it. This area over here is the average of all those 15 last candles. The average price, it's this point over here. Now, because it's simple moving average, the weight of every candle is the same. By that, when we have a bearish market like over here, we can see that the difference between the line, the SMA, and the market is quite big. Now, what does it tell us? It tells us this is a very bullish market. When we have a strong difference between the SMA and the candles, it means that the market is quite strong right now. And when it's below, it means it's a bearish market. That's the main idea behind it. Now, how does it help us to trade? It wouldn't help us by itself. We need several lines, and let's take a look at this with this example over here, how it will tell us a little bit more regarding the market. We have three lines over here. We have the black line, which is the average of the last 15 days in the market. The red line, which is the average of the last 45 days in the market. And then we have the blue line, which stands for the average of the last 100 days in the market. The first thing that we see over here is that the blue line is below the red line and the black line is above all. Basically what it tells us over here, because the blue line is the average of the last 100 days, first of all, this is the S&P 500 daily chart. So because the blue line is very below, it tells us that in general, the average of 100 days, we have a very, very bearish market, a bullish market, sorry for that. And the red one tells us the same thing. Now, how do we take it to our invention? First of all, we know right now there is a bearish market. So every time, the moment, sorry, that the market will break the blue line, for example, it means that the market flipped over, turned over, and from now on it's a bearish market until it will break it again. The larger the number that we pick, it means that the movement is kind of stronger. This is basically for that. Now, how do we trade on it? Let's take a look at this example. This is a way that we will recommend to do it. To pick two averages with quite a difference between them. As the difference between them, that tells us that the strong of the movement, the size of the movement will be a lot bigger. Over here we have in red moving average 14, and in blue we have moving average 50. Now, as we can see, when the red line is above the blue line, okay, it means that the market is in upward trend, starting going up. The opposite, it means that it's going down. So basically, at every time, every moment that the blue line meets the red line, we should open a position. Let's see what happened, for example, over here. If we would have opened a position at the moment that the red line broke the blue line, it told us, look, the market flipped to a bearish market, and this is actually what happened over here. But the other side, when the red line passes the blue line, it means that it's a bearish market, and we can see, in fact, that the market really went up, and the other way over here. Okay, you can tell me, look, we know the market is kind of right regarding that. Okay, break it down, bearish market, bullish market. But basically, what we're looking at right now is a very, very easy trade in Forex market, in FX or CFD. Let me add it again. We have this as well on our platform. You should check it. The main difference over there, because over there we're looking for some sort of movement, and the most important thing, there isn't no time frame. If several of you will ask, maybe at the end of this session or the next session, we will talk a little bit more about CFD and FX trade and how to do it on our platform, but this is basically for another time. In binary, we have a time experiment for every position that we open. So as I said in the beginning, the important thing for us is the relation between them. So we're looking over here at a 30-minute chart, which tells that every candle represents 30 minutes in the market. So if I will consider and open a position over here, I will open a position for a minimum of 2 hours. Okay, so as we were of, basically those positions over here tells us that if we will open a position regarding it, it will be a position for the end of the day in binary. So if it would have been a position for the end of the day, as we can see over here, we probably would have won all those positions because the difference between the starting price and the end price is quite large. This is basically what I want to talk about MA. If you have any questions, feel free to write them right now or at the end of this session. The second thing is a bit related to MA. It's as well built on an average in the market. It's Bollinger Bands. Let me just show you that. It will make things a lot more clear. This is basically Bollinger Bands. I'm guessing that a lot of you saw them around the market in general and in websites, economic website. What we're seeing over here, this line in the middle, it's basically MA15 of the market. The main difference is that we added 2 more lines, upper line and below line as well. Those lines will tell us more regarding the volatility of the market. Now let's think a little bit about it. We tend to believe that when the market is volatile, when we have a very, very strong movement in some direction, doesn't matter if it's up or down, the market tends to correct himself. Now, if I wasn't quite clear about it in the beginning, the best way to trade with technical analysts is with currencies and indices in the market. Basically, to work with things that don't tend to move a lot. Therefore, in currency, for example, when the market is very, very volatile and there isn't any major events behind it, let's keep it in mind. If there is a major event, it could affect us as well. But if there isn't any major event, the market will tend to correct themselves by the end of the day. This is why it's a lot more easier to trade with all those indices, with currencies and major indices in the market. So this is basically Bollinger Bands. Let's always remember that when the bands are quite wide, it means that the market is very volatile. And when they are closed, it means that usually the market isn't volatile at all. And you know, it's like a spring. When you crush a spring, it tends to pop. And those things. The below line over here that we've seen, this is the RSI, which stands for Relative Strength Index in the market. Basically, it tells us the power of the buyers and the sellers in the market. It also calculates as well as the average of 14 last days. What's important from it, and you should write it down, is usually when the RSI is above 70, we have overbought in the market, and when it's below 30, we have an oversell in the market. Now, how do we work with RSI? The easiest way, and this is in a perfect world, is, for example, if the RSI is passing 70, we will wait until it's break it down again. We will open a position only when it will be below 70. And the same thing regarding 30 when it's getting weaker. we'll do exactly the same thing. Now, the way to work with those two things, Bollinger Bands and RSI, is to combine them. So as we said before, if, for example, we decide to trade and we see that the Bollinger is quite wide, every time that it touches the upper side, for example, over here, or over here, all this area, we will consider to open a put position. We'll consider the market to flip. Now, for example, if we trade it just with Bollinger Bands, over here we'll consider open a position, over here, over here, over here, and look at it. If we open over here, in this case, it's kind of strange because we probably would have won 4 days, and that's happened as well in the market. But according to the rules, it's not the same with it over here and after it as well. What's important for us is to see the both things happen at the same time. So when we saw that the RSI touches 70 and break it down again, and the Bollinger Bands, as we can see the candles above it, quite outside, we will open the position. Here as well, what we see over here, this is a 5-minute chart. So I will trade to 30 minutes, or even I will try 44 minutes. It depends on the time with expiring on the platform. But as you can see, we usually would have won. Now over here, while we're trading, this is a good place to double the position. If, for example, we open a position of 100 United States dollars and we would have lost, and we saw that the market is still above the Bollinger Bands and the RSI is quite high, I will consider doubling the position to turn up in profit. I'm guessing you all familiar with this strategy as well. It's very, very helpful in those cases over here when we trade with Bollinger Bands, RSI, and a lot more technical analyst ways. On the other side, we can see over here in the downside as well, when the market started going down, when it broke it, we started considering open a position over here, but the RSI didn't reach 30 over here. Over here, it touched 30. You probably don't see it, but it break it down, and then it started going up in this area, on this line. And as you can see, it's really the line of the turnover of the market as well. So in this case, yeah, it's quite easy to say in this case, it doesn't matter the time frame that would have chosen the position would have finished in the money. This is basically the end of the technical analyst part of our session. If you have any question regarding that, feel free to ask me right now. And now I want to pass to the market brief to talk a little bit regarding the earnings season and the major events that we have ahead and what happened basically in the last few days. The last few days of the week, let's start, with not what happened with Bank of Canada, but with the United States non-farm payroll. We noticed at the beginning, the market took it in quite a shock, let me put it like that, regarding the great numbers with the United States non-farm payroll. The market did not expect those numbers, 222 new jobs. What's more than that? We can see that the United States dollar is kept on getting weaker. So the question for us in those cases is what will happen when we have bad data regarding the United States? We need to keep it in mind. So right now, while you're trading on the USD, I will recommend to take a look regarding what will happen with the United States dollar, basically the basket of the United States, the indices, or that just trading with the United States, but only to trade with it in a certain of Forex CFD way, not with binary, because regarding time frame, it's very, very hard to anticipate what will happen with that. The second thing, the market was quite volatile yesterday with Bank of Canada. I don't know if you were aware of, but the interest rate change that we had in Canada, basically this little thing that we're looking at over here, the collapse of more than 200 pips with the USD versus Canadian dollar. This was when the interest rate in Canada raises from 0.5 to 0.75, the first raise in the last 7 years. And let's keep in mind, they did that raise with what happened with prices of oil. And when we said 2 lessons ago, when prices of oil goes down, it's bad for Canada economy. And if they feel safe enough to raise interest rate, then that's why we saw it in the market, because people didn't really anticipate it to happen. The situation in Canada is not very, very well regarding that. And this is why we saw that effect in the market. I'm guessing that most of you got the trade from your account manager regarding the USD versus CAD, the FX trade regarding a call position, because we expect somewhere in the future that the market will correct itself. If you didn't get the trade of the day that we had today, just talk with your account manager. He will deliver to you as well. The second thing that I want to talk about is the most important thing right now, basically what everybody is talking about. From tomorrow, we will have the beginning of the earnings season in the United States market. The first major banks will report, with Citigroup and JP Morgan, tomorrow before the American market is open. That's mean for us that we will want to trade on those Citigroup and JP Morgan. But if we will open a position, we will open a position today regarding the reports of those companies, and that's basically because the report will be before the market will open, and then we will see the movement immediately when the market will open. We wouldn't have a lot of time to react. Although several traders prefer to trade after the results are out, this is a way to trade on it as well. I can tell you that our department is expecting quite good reports from the banking industry. Basically, the raise in interest rate that we had in the United States should have a very, very good effect on the profit of those companies. The problem in that could be that because we're expecting those good numbers, and everybody quite expecting, the market could be caught with surprise with normal numbers, but I wouldn't say it like that. Right now, we're looking for some good numbers with the banking industry. I will recommend most of you just to take a pen and write the dates that you're seeing right now. This is the dates of the report of the major banking industries in United States. I will give you a few seconds to do that. You can print screen as well with the keyboard if you would like. So this is, as I said before, the banking industry. The most important are our Citi, JP Morgan, Bank of America. I'm hoping that all of you remember what we talked a little bit regarding Buffett, and after that we'll talk a little bit more about it. Warren Buffett just purchased a very, very large amount of stocks of Bank of America. Basically, have a very, very strong belief in general regarding the American stocks of the banks over there. He truly believes them, and as we said, when Buffett buys things, it usually has some sort of effect of the market. And as well with Bank of America, we have Goldman Sachs that report the same day. On the other side, and those are the stocks that we really recommend you to write down, is the major stocks with the technology. The important ones over here for me, at least in my mind, that we really see a volatility that we could trade after as well, is Netflix, for example. Let's keep in mind when we're looking at reports of Netflix, the only thing that we're looking at is how many new subscribers the company have. As long as we have more new subscribers, it's better for the company. And this is the only number that's important for us. After that, we have eBay and Microsoft and Alphabet, which is Google. In those companies, I will look forward for Microsoft and Alphabet. Their reports will be quite interesting. After that, the most important one over here is Facebook, Amazon, Apple, and Alibaba. I can tell you in general that all the companies reports, but those are the major reports in our mind, and those are the reports that you should follow. This is basically the end of this session, of this webinar. You feel free to write any question that you will have right now. I can answer them. In general, right now, I just got around to tell again regarding the importance of this earnings season and the reports in the banking industry. And if you have any questions, feel free to write them down right now. My name is Jonathan Klein, and I want to thank you all for your time. Okay, see that there are no questions. Thank you all for your time, and I wish you all a very profitable day as well.